Hello, everyone, and welcome to today's Startup Equity Matters, a podcast about how to create value from startup equity. We're going to unpack stories from capital raising, team equity, ownership culture, and exits and stuff like that. And today's topic is creating wealth through startup-focused family office. So, yeah, I'm excited about today's guest. They've had a career in innovation, a multitude of leadership roles, and now the CEO of a tremendous family office, Euphemia, that's backing the best investors and founders out there. Also, full disclosure, Euphemia is a cake investor. Thanks for the support. I've enjoyed working, with Judy over the years and seeing her awesome leadership, and really grateful to have you on the podcast today. Welcome, Judy Anderson-Firth.
Thank you, Jason. It's a pleasure to be here. Like, cake is just such an awesome business, and when we saw the opportunity to invest come up last year, like, it was an absolute no-brainer. We're like, how can we get in? Like, what's the maximum check we can put in? And there was limited allocation at the time. So, it's a joy to be a part of the journey. So, thanks for having me.
I absolutely love hearing that. And there's a lesson out there for all of you founders. Find people that care about your mission, that are aligned, with your mission, with the problems that you're trying to solve, and life just keeps getting better and better. So thanks a lot for that. So look, thanks again for joining us as well. Tell us a bit about Euphemia. What's your vision and mission?
Yeah, so Euphemia is the family office for Aussie fintech entrepreneur and investor Dom Pin. Dom is most well known for being the co-founder of Up, which is Australia's most loved digital bank, which sold to Bendigo and Adelaide Banking Group at the end of 2021. Very popular with under 35s. If there are any upsiders out there, like, shout out to you. It's like such a great product for financial literacy and well-being. But prior to that, Dom, he's an entrepreneur of 20 years. Oh, you've got some product stuff.
I just got this the other day, my new card. Even though I'm a tad over 35, I'm not going to tell you exactly how old. I'm still what are we called?
Upsiders. You're an upsider. Yeah, that's right. And it's an awesome business for, like, financial wellness. Seriously, like, I became an upsider after discovering Up at the Pause Fest in Melbourne a few years ago. But Up aside, it's an incredible business. So
amazing branding. Like, how do you make banking actually feel fun and, like, the bank really cares about you? All the big banks kind of they say all the right things, but it never kind of feels right. But this actually feels like it. It was such a great mission and super fun.
Yeah, and beyond the branding, like, to make it practical for those who haven't discovered Up before, like, for example, one of their features is something called Maybuy, which is a bit of a sort of reaction to the buy now, pay later, trend in the financial services sector, particularly for young people. So rather than, using a buy now, pay later system, you can use Maybuy, where if you're in the shopping cart looking for a new pair of sneakers or a new set of, I don't know, you want a new TV or whatever it is that you want to be buying, rather than doing it like an afterpay model, you can add it to your Maybuy in your Up app, and then you can actually save up towards buying that product. And so it basically helps customers to buy things that they actually want with money that they actually have. So just like one example of, like, some of the great features that they've got. There's heaps more, but I won't bore you with them all.
Well, yeah, that's kind of what I mean about, a great brand has a product that matches, what it says on the front, and that's what I love. Super innovative and really caring about the customer and solving real problems. So, huge effort there. And so that was a big part of the establishment of Euphemia, I suppose.
Yeah, that's right. So Euphemia is the family office of Dom, and together we manage a global investment portfolio of about 70 million, and we invest across four main verticals. So we invest in fintechs to try and help fix money, climate tech to try and help fix the planet, women-led startups, or really any founder from a disadvantaged background who hasn't had equal access to opportunity, and then startup infrastructure, which is kind of like a niche corner of B2B SaaS, where you're a high-growth tech company whose customer is a high-growth tech company, a la cake. And so that's really the types of companies we invest in. We're typically investing in pre-seed to Series A when we're investing directly in a company, but we also invest in funds. We're invested in over 20 funds, both here and abroad, across across pre-seed up to private equity. And more broadly than the venture portfolio, the family office group at Euphemia, we have a property portfolio, a little bit of commercial, a little bit of residential, a share portfolio, which is mostly listed tech stocks, and a foundation to help people in need. So yeah, that's the business of Euphemia. And like, we really are here to make awesome. We are trying to uplift the entire Australian startup ecosystem to help create more family offices that look and feel like Euphemia. Like, what could a new first generation family office created from tech wealth look like? Because Dom's an entrepreneur of 20 years of hard knocks. He's most well known for being the Up co-founder, but before that he had PIN payments, Clear, like so many. He's lived and worked in Silicon Valley, London, Singapore, like the list goes on. And we've both worked in entrepreneurship and tech our whole careers. So it's a really exciting time to be at Euphemia.
It's a wonderful business. We're mega aligned on mission and vision around creating innovation, entrepreneurship, and driving the Australian ecosystem forward. So very grateful to be having you on our side and leading the way. You mentioned a bit about your background. I'm excited to dive into that in a tick. But before we do that, as a CEO, what are the big three things you're working on at the moment? It's always interesting to hear what people are really focused on.
Yeah. I'll start with an exciting one, and then I'll slide a boring one in the middle, and then finish with an exciting one.
Is that called a shit sandwich?
Yeah, the boring, exciting sandwich. The exciting one is we're helping a lot of our companies that we've already invested in. So we've got over 50 direct investments now within the portfolio across those 4 verticals that I just mentioned. And so Dom and I are spending a lot of time working with the founders and the executives within those teams, looking at their next capital raise, and like playing a bit of a like sort of strategic advisor role there on like, what does that rounding to look like? How do we set it up for success? Who should participate? What should a lead look like? What should the price look like? Like some of those kind of things. So working on a little bit of cap raising strategy.
Cool.
One of the boring things is we're just setting up some boring tax compliance across the group. There's about a dozen entities in the Euphemia group, and they all have their own P&L and balance sheet and tax.
It doesn't get any better than multi-entity tax planning. That's fantastic.
It's
very
that kind
important.
of
Very important.
time of year. It is very important. It's that time of year. Obviously, I don't have to do everything. We have fantastic accountants and tax advisors, but it is my job to make sure that it gets done. And the last exciting thing is just the time of year. Like, we actually just get to celebrate everyone's accomplishments. It's a really difficult, it's been a challenging year for everyone. The market's span on a dime. Everyone had to recalibrate. We've still got a lot of companies like only now just sort of refining their feet after the year that it's been. And so we're actually spending a bit of time, it's the 1st of December today, not to date this podcast, but it's, it's a time for celebration. So we're spending a bit of time with founders just looking backwards and celebrating their accomplishments.
Love it. Yeah, I'm sure some founders are super hard on themselves, especially in a year like this year. So we all need to get around each other and make sure that we acknowledge all the progress that's been made. I think a few times throughout the cake journey, you're just grinding away. And when you do take time to look back across the whole year, you can be pretty shocked how much has been achieved. So yeah, good shout out.
Yeah. Like, every startup should create their own Spotify version of like the 2023 Wrapped or whatever year you might do it for. Like, necessary.
Awesome. All right. So how did you get into innovation in the first place? Looking at your LinkedIn, looks like you were kind of born into it. What's the origin story of your passion, for innovation, Judy?
It does feel like I was set up to have a career in tech and entrepreneurship, in innovation my whole life. My dad was a railway engineer, and my mum was a primary school like creative arts teacher. So on one side, a super linear dude and a super creative mum. The combination of the two just, totally set me up to be fascinated with problem solving, but not just solving a problem, like convincing other people that it worked. So, my dad's idea of playtime was going to a garage sale, buying a computer, bringing it home. We'd pull it apart. We'd have to put it back together again, make sure that it worked.
Really? Wow.
That kind of, so very much set up. And then in high school, it was very obvious, like the subjects that were easy were business and literature, which are all about like the answer is whatever you can convince someone the answer is, as opposed to what the black and white science tells you. Not that I'm not a lover of science. I studied entrepreneurship at university. So I always wanted to invent things that would change people's lives. Like I was always tinkering around, like, my mum would always lose her glasses. And so, I entered an invention competition in primary school, and I was like, I'm totally going to solve that problem. My mum is always interrupting my playtime with my sister to help her find her glasses. So I went down to the hardware store, bought a little tracking device, soldered it on to her glasses frame. And then I put a finder button on her car keys. And so anytime she lost her glasses, she could just press this button and go off and find her car keys. And, it was awesome. I ended up winning this competition, but then she lost the car keys a week later. So it didn't end up being as very good. But like that sense of like invention and being fascinated with that, I've always had that as part of my DNA.
Yeah, it's very hard to account for all user error when you're innovating.
Yes. Prime example of that learning.
Awesome. So yeah, right from a very early age, you just had the spirit and you had that problem-solving attitude. Amazing. Very cool.
Yeah.
Very cool.
Yeah.
What are a few of the highlights and maybe a couple of inflection points along the way? Because I think, before Euphemia, CEO of a pretty major, industry group here and quite a few cool leadership roles. I saw you were a keynote speaker, quite a few years ago, early on in your career. So were there a couple of inflection points along the way that you could share that were kind of important?
Yeah, definitely a few. And as they say, like hindsight's always 20/20. You can find what those moments are when you look back. It's a lot harder to know when you're in them.
Yeah. So true.
But what they all kind of have in common is that they all felt wildly uncomfortable at the time. So my first one, was when I was at Deloitte very early in my career. I'd finished my studies in entrepreneurship, and I couldn't get a job, ironically, because entrepreneurship was a really unemployable degree to have chosen. And, I couldn't find a job. It was like, a recession was in flight, and I really was struggling. And so I ended up taking a stint, selling toilets at Reese Bathroom Life, believe it or not. Just, finding any job, to pay the bills. And I was very persistent to get this job at Deloitte because I wanted to learn how innovation was done at the top end of town. Like, how do really big companies innovate and keep disrupting? Like, how is that done in practice? I want to be a part of that. And so I'd applied for 3 different jobs in various sort of innovation and tech roles at Deloitte and got rejected 3 times. And then the last time I finally nailed the perfect role, which was in the innovation team there, working for the chief strategy officer to help every service line within the business to create new products and services for clients. And whilst it felt really uncomfortable to keep pursuing what I wanted, because everyone just kept telling me that, the answer was no, I just didn't take no for an answer. And so I was really glad that I persisted because, being in that role really set me up for success, because it was my job to basically train the whole organization in design thinking. We brought the D School out from Stanford University. And so I got a front row seat alongside all of the other partners in the business at a very young age on how to do business and how to innovate. It was incredible. Another big inflection point was taking a risk and leaving that all behind and going to a niche consultancy. I then went to a boutique firm called Inventium that used organizational psychology, neuroscience, and management science that taught large companies like Deloitte and ASX 250 style to innovate and use those methodologies like Lean Startup methodology, Clayton Christensen's, disruptors, innovators dilemma, etc. But again, another big inflection point there. Several years later, I was running our Silicon Valley tour where we would take our APAC exec clients over to the Valley and we, show them what innovation looked like in practice. And one of the rooms I was in was with Alan Blue he's a co-founder of LinkedIn, former PayPal co-founder, part of the PayPal mafia.
Oh, wow.
And I was just, epic. And I was sitting there listening to him talk, and the way that he talked about the world, his vision was so much bigger than anything I'd heard from any of my clients in the last 5 years. And I just thought, I'm in the wrong place. I thought I could make the biggest impact at the biggest end of town, but actually I've got it all wrong. It's actually at the bottom end of town. Entrepreneurs and founders are achieving so much more with so much less. And they're just exciting to be around. It's infectious, the energy and the progress and how fast they moved. I was like, I got to quit my job. I got to find where the founders are. Like, how can I take everything I've learned in my corporate innovation career and apply that to the startup sector and help. And that led me to Startup Vic. So that was my previous role before teaming up with Dom to run Euphemia. So Startup Victoria, which was now known as the Startup Network, is Australia's largest startup community with over 60,000 people in the network. And so my job for many years has been to help founders go from I've got a great new idea to an exit and everything in between, bootstrapped, venture-backed, fast growth, slow growth, B2B, B2C. I've kind of seen it all and worked with thousands of founders. And yeah, I've definitely found my place. You can't kick me out of this sector. I love it so much.
No, your passion and the fun and the enjoyment that you take from your role is really obvious when working with you. And I have had the same realization since I got into innovation, just being around all the passion, positivity and drive to change the world is a very fortunate place to get to spend, your working hours. So yeah, I totally get you there. Right. So we're going to switch now and talk a bit about equity. It's an equity related pod, and I love what we're going to do today because, we haven't really talked equity for family offices on the podcast so far. And we've got some really unique and insightful, things to talk about, which is great. So to kick us off, you were telling me earlier that you want to help create a lot of euphemias. So how do we do that? And how do people make money from family office? Hey, how are we going to do it?
Yeah, that's a great question. So for us, like we're investing a significant portion of like funds under management into the venture sector, so startups and funds. And the reason why we're doing that, we're not actually setting out to create a multi-generational family office where, future generations are inheriting a nice big pile of cash to do whatever they want with it. Like this is something where we're giving back to the next generation of the startup ecosystem in Australia. And we want to see more entrepreneurs successful, more employees and early investors of these businesses successful because, more begets more. Like the more success we have from the sector, the more companies that are created, the more technologies that get progressed, the more value that's created for society. And we can actually start to solve some of these big problems like climate tech, like the financial sector and its inequality. Like there are so many big problems to solve, and we're totally biased towards like the combination of technology and humans being used to solve those problems. So yeah, our goal, beyond the actual work we're doing today is that by receiving investment from Euphemia, a company will succeed and they will become very wealthy and they can create their own family office and they will in turn invest back into the Australian startup sector to help create more of the companies that they build. That's our goal. That's what we'd like to see.
Yeah, so cool. So you're only going to continue to be successful if we're all successful. So that seems ultra aligned.
Yeah, exactly. Like if no one, like money is a significant marker of value in our economy, and if no one's making money, then there's a pretty strong argument that we're not actually creating the value that we set out to, or we're not capturing it. So yeah, definitely. We want to see founders become wealthy off the back of the value that they're creating for society, and then do something good with that wealth.
Yeah, I love it. And we're already seeing some of that coming through, aren't we? I mean, setting up a family office requires a certain amount of wealth. So that's, only the most successful exits are going to probably allow you to set up your own family office. But I think we're seeing, in Australia, probably the second and third wave, maybe some third wave coming through now from an investment standpoint. Certainly some family offices. I mean, I think if you go back even 10 years, there wouldn't have even really been any tech family offices, maybe 15 years. But we're really starting to see them proliferate. And I think there's so much more opportunity in this space. So really exciting to see. I suppose I'd never heard of anybody really trying to provide leadership in this space. I only found this out, earlier when we were talking. I think it's just such a cool way to see the world.
Yeah, thank you. I mean, but it's by design, like when Dom and I were first sort of, workshopping strategy and, like our mission, our vision, our values, like what success looks like. We took a look at the competitive landscape as you do, and we just, having lived and worked in the sector for so long, typically a family office is opaque, by design, hard to find. You don't really know what they invest in. And if they do have a website, it might showcase some portfolio companies. It might tell you about its thesis, but it's kind of hard to find the front door. And
they'll have a very small fraction of their wealth allocated to venture, and they'll be coming in and out.
That's
they
right.
won't really understand it. They probably don't have any dedicated team members that even really know how to do it. So you've got property or fixed interest investors then making venture decisions, and of course they're always too risk averse to even invest. So I've definitely seen the wrong way to do it a couple of times in my career.
And look, let's be real. Like, I'm not saying the way that we're doing it is the right way to do it. There are a lot of very wealthy people who would look at us and say, "You're crazy," because if we work with LGT Crestone, they're sort of like our wealth advisors, and a normal pie chart of asset allocation, typically one of their clients would maybe have like 20%, this little thin slice allocated to alternatives, which is like everything in venture, both not just direct investments, but the funds. If you're investing in Airtree, Blackbird, Square Peg, any mid-market or early stage funds, it's all in that one bucket. And Euphemia's is like 80% plus. And so they look at us like we're crazy because you have to have a high risk appetite, but it's also high return potential. But we believe that we would be wasting an absolute advantage that we have, which is our networks within the sector and access to unique deal flow, and also our ability to do great due diligence, because we've built companies before, we've managed companies before, and we know what it takes to build a great business. So, and we're playing in the fields where we think we have an unfair advantage: fintech, climate tech, women-led, and startup infrastructure. So we're comfortable taking that risk, but others might call us crazy.
I can totally appreciate that. There's more than one way, to do everything, and no one really knows, the right way, in inverted commas. Awesome. Well, look, congrats. So we're creating wealth from family offices, and you're only creating wealth if the industry succeeds, your portfolio succeed. And I suppose the historical returns on good quality, venture investing is really quite good. So as long as you keep yourself in the top, the top quartile, everybody's winning, right?
Well, that's the thing. You have to be good. Lucky for me, Dom's been an active angel investor for over a decade. So whilst Euphemia is new, like, Dom's been investing, and some of his early investments include Afterpay, which was Australia's most successful exit, $39 billion, which was that wasn't Dom's portion, but that was the overall sale price. He was in Twitter early, which was acquired by Elon Musk not too long ago. Like, there are some like Spreedly, which is a US fintech unicorn. He's got some amazing early stage investments, and he's seen some great IRR from his earlier portfolio. So lucky for me, we're building on a really great stack to start with. And the other advantage being a family office is we're not on the same time horizon for returns that a typical VC fund would be. We're not bound by like a sort of 10-year timescale. We can think in multiple decades, which gives us an advantage as well.
Yeah, cool. You'll have to let me in on these good deals when you're looking at them as well, okay?
Yeah, we're funny enough. We've got one coming up next year. You might know the company.
All right, very good. Okay, so then, just say people out there are looking to, set up a family office, or, maybe they already have a family office and they're thinking about how to transition a proportion of their wealth into, into venture, or I suppose they could be looking to try and attract, retain and engage a really high quality team. At Cape, we're very passionate about employee equity, or team equity, ESOP it's sometimes called. In a family office structure, the family office structure that I've seen previously, I don't know how I would have ever done it. So I'd love to, for you to share how you're tackling that at Euphemia, because it's kind of about rewarding and incentivizing people, bringing them on the journey, keeping the team together over a long period, making sure that, I know in startup land, you're all building this company together, and you want to make sure that everybody's really winning, at the end of the day. How are you tackling it at Euphemia?
Yeah, it's an interesting one because as I said before, we don't have just like one company, that we can offer some skin in the game for, right? For employees and advisors, or, but we definitely want people to share in the upside, like if we're winning, we want the people that helped us win to win as well, so totally aligned with Cake's philosophy around, making sure that everyone gets reward and recognized for the value that they're creating. So for us, we basically had to create our own version. So across the Euphemia group, we've got about a dozen entities. Some of them are focused on venture, some of them are focused on property, some are focused on listed equities, and some are focused on foundation activities and some other personal activities. So, we had to look at like where across the group is the most value being created and where does it make sense? Like, so we actually had to look at what asset classes do we want to include? Like, do we want to include property? Do we want to include equities? Do we want to include venture? What makes sense? And we came to the conclusion that the answer is it depends. It depends on who the person is, and it depends on what they're working on. So already right off the bat, it's like, okay, whatever we build needs to be flexible enough to work for property and work for venture and work for listed equity. So it has to be super flexible. And then the question became, well, what about time? Like, when is someone coming on board? Like, we're a family office. We're thinking in decades. So like, if you're working with Euphemia, you're probably working with us for quite some time. Like, this is, it's not something where we're expecting tenure to be like, a few years. Like, you hear like Dom and I have committed to each other for a decade at least, like that's the time you need to really work this strategy to fruition and create and see if we can deliver on it. So, we need it to make sense over time. And so if we've got different people joining us along, this multi-decade journey, how do we make it fair? Like, how do we make it fair when someone comes in from day one? How do we make it fair when someone comes in a couple of years' time? How do we make it fair if someone comes in at year 10 and we still got 10 to go? Like, how do we make that work? Because every person is sort of building on the shoulders of the person that came before. So it has to make sense in terms of when someone starts. And then the last part is it has to be generous, like some core principles, like we want it to be generous, and we wanted it also to reflect best practice, because anything that we do, we want to be able to set an example for our portfolio companies and funds. So whatever we do, we want them to follow our lead. So with those principles in mind, we basically scoured like, what do other family offices do? What do other funds do? What do the best companies do? We just spent a lot of time researching to see if there was anything out there that would make sense for us. The bad news for us is that there wasn't, so we kind of had to build something, but we were able to sort of take the best bits of what we found in market. So, we were able to take the best bits of what we see in great ESOP plans, right? Like good leaver provisions, bad leaver provisions, what sort of commercials, are typically like right in terms of how much as a percentage of overall, success like makes sense to offer, what's generous, on top of those standards. We were able to take the best of like partnership models from venture funds and, what does carry look like? How is that carry earned or bought over time? And so, we could basically take the best of industry standards. So it sort of looked like an ESOP, felt like an ESOP, but it's not an ESOP at all. So we call it the Euphemia Incentive Plan, which is a really boring name. It probably needs a better name. But the incentive plan is basically, it's basically a loan structure. So what we're trying to do is create or mimic actual ownership of an asset without creating any negative tax consequences for either party, or any sort of cash flow consequences for either party. So it's basically a loan structure where for every asset that it makes sense for you to have some ownership in, we as a group are loaning you a percentage, and what that percentage is like on a case-by-case basis, but overall we have a set percentage across the group. So it's about 20% is allocated. So similar to an ESOP, you'd find anything from 10 to 25, like we're at about 20% overall for that pool of incentive plan. And then, what your percentage is as an employee will be representative of what your value is. So similar to an ESOP, right? Like you just choose what's right to allocate to that person. And then for each asset, a new loan is created. So let's say, for example, we invested in a company called Cake, and the Euphemia group, this isn't the amount we invested in, this is just to give a simple example. Let's say we invested $100,000 into Cake. that means 20% of that, so $20,000, gets allocated in terms of our cost base to the incentive plan. And so a loan is created for lots of little micro. Let's say we've got 2 people, for example, in that incentive plan. That means there are now 2 $10,000 loans sitting against that. And when that asset is, if that asset goes to zero, it's a no recourse loan. So Euphemia is never going to come after an employee for 10 grand, right? Like if it goes to zero, then that loan is not recourse. If, however, that asset goes to, let's say $100,000 turns, I mean, this would be an awesome result, but let's say $100,000 turns into $1 million. And now all of a sudden that 10K loan that you had as part of your Euphemia incentive plan is now worth $100,000. You have, you get the benefit of that asset going from 10 to 100. And what happens with the cost base of the loan is dealt with at the time of the liquidity event. So that's how it's structured. So then you basically have a whole register. This is why we need great accountants. We have a whole register of these sort of limited recourse loans set up across the group. And then terms of
Cake isn't currently set up for that kind of thing, but it's innovative, and maybe one day.
It's a gigantic accounting legal workaround to try and create like best practice principles in a system that's ultimately flexible, because it still also gives us enough like control and flexibility as a Euphemia group to change circumstances. So for example, like one of the things we needed to cater for was like, what if we have, how do we facilitate our own internal secondaries? Like a lot of the assets that we're buying are like 7 to 15 year time horizon liquidity assets. Like they're not very liquid. What if we have an employee who wants to put a deposit down for a house, or I don't know, maybe there's a family emergency and they need to liquidate. So like maybe on paper they're worth $1 million, but they've got to wait at least another 5 or 7 years until there's a liquidity event. This gives us the ability to do internal secondary. So Euphemia could actually buy back that asset and do an internal price purchase of that asset. So it's super flexible. It's pretty awesome. But those contracts all have the same good leaver, bad leaver provisions that you would expect.
Awesome. Love it. Oh, well, look, congratulations on solving that. It sounds like a bit of work, but based on what we do at Cake, we're so grateful when we hear of people working hard to, reward and incentivize and build great teams over the long term. So yeah, nice work. I think that's the most complicated, system. I don't take that the wrong way. Like it was a complicated situation, and you built an awesome outcome. That's really great. Love it.
Yeah, and the only other little asterisk I put under it is like how we think about what's included, because the group has so many different things. Like, and this is where time really came into it. So, for example, like if there was an asset that existed before your time, let's say, you become a part of the Euphemia team in the future, and there's already an asset which doesn't really require much servicing, capital's already been called, maybe we do some things with the like portfolio success activities from time to time, but, there's not too much, value being created ongoing, then that would be excluded. But if it's something that happened within your time, then it would be included. And so each employee or each advisor, each person that has a plan has a different plan to the person next to them based on when they started and based on what they work on. So it's all a little bit of a unique, it's definitely a lot of admin, but it gives us the things that we want around generosity and flexibility.
Yeah, it sounds like you need to update, sort of be looking at that and updating the details, a little bit from time to time.
That's right. Yeah, definitely required. It's just part of our like bookkeeping process at this point.
Yeah. Awesome. Very innovative. Well done. And so moving on to our next really interesting piece, and thanks for doing this work, by the way, having a chat with your portfolio and some of the founders, and bringing some insights from, their journey on, co-founder splits and co-founder equity and how that's worked, and employee equity, at the various startups. Super keen to hear a bit about what you learned.
Yeah, I mean, I was telling you earlier, like the one of the reasons why I wanted to speak to a handful of our portfolio founders was just to get a read on like are we starting to see best practice emerge in Australia yet? Like, are we starting to see, like, how consistent will these answers be? And even the exercise alone was interesting because for the most part, everyone had a total different story, which I think in itself is telling, right? That we haven't yet hit like saturation on ESOP being normal, being standard, being market, like within Australia, we're not there yet. I thought that was interesting. So we've got everything from, founders who started their companies by going through an accelerator. And so everything was really easy, like that's an accelerator that pumps out dozens of companies a year. They've got templates, they've got standards, they've got rules, so it's like they just had to sort of follow, like the masses and sort of just like, it was easy really, didn't really have to think about it too much. And then you've got companies that are more like bootstrapped or independent for the majority of their early days. And there's a lot more painful, they kind of had to spend a lot more on legals. They weren't sure exactly what was right, or they tried to get a little bit creative with certain terms, but then they ended up biting them in the butt later, so there was no consistent theme. But in terms of co-founder equity, the one consistent thing I will say came out was most founders still have equal equity at the start. But there was a great insight from one of these companies around reverse vesting of that equity and making sure you have your buybacks in place for when co-founder relationships dissolve, and when a co-founder is no longer adding the value promised, because you don't want to have a gigantic portion of vested equity sitting in a founder who's no longer, building the business.
Big red flag. Yeah.
Yep. So a lesson learned there.
Yeah, sweet. And then what about on the employee equity side? Any sort of key insights? Obviously, a fair bit of different stuff going on, but I guess anything stand out that's worth sharing?
Yeah, the consistent theme for employee equity, or like the lesson, from a lot of these, and I spoke to about half a dozen, so it's not, the single source of truth, but it was a good, I think, representative sample of a typical, Australian early stage company. And the insight was basically they started their journey with their ESOPs being designed super employee friendly, like incredibly employee, because they want to attract the best talent. They're an early stage startup. They don't have enough money, to really like offer highly competitive salaries. And so ESOP's a great way to, get people on board. And typically these are employees that have never really had an ESOP before. So, like they thought they were doing the right thing, like being super employee friendly. But a lot of those things were either wasted because no one even knew that they were so employee friendly. They didn't really understand what a win they were getting, with these ESOP plans, or it came back to bite them later when, they would have levers and they weren't, good levers. And then all of a sudden they had no legal mechanism through which to take back that equity. And it was equity walking out the door, not just with value not received, but in some instances, being eroded. So that's the consistent theme there, is that sort of, trying to find the balance between being company friendly and employee friendly, and off the back of having like the worst case scenario happen with an employee, which eventually happens, with scale. You can make a bad hire. It's only a matter of time, making sure your ESOP does have the right protections. And so those founders now who are at later stages do typically lean more towards having a company-friendly policy.
Yeah, makes sense. We have the standardized version in Cake, and we built it over years. And I remember early on, just the more complexity and the more variability in the plan created so many problems for the founder, the company, and more legal fees, and employees never understood any of it anyway. So now we have the highly standardized one, which is employee friendly to a degree, but still protects the company. And you sort of need to navigate that, nice and in the middle there somewhere. And I must say, even at Cake, we have become a little bit more on the Cake protection side with the ESOP over the years. Even though we 100% have our team in mind, I think you can be a little bit friendly with those terms, and it doesn't necessarily help anybody. So interesting insight there.
And also but I think Cake's right to do that, because at the end of the day, I've been waiting for the right moment to sneak in a Cake pun, but do you want a bigger slice as an individual employee or as someone who's still remaining in the business after someone leaves? Do you want a big slice of a small pie, or do you want a small slice of a gigantic pie? And at the end of the day, like, as companies scale, as one person, there's only so much you can contribute to the end outcome, of having a successful exit, a liquidity event. And so at the end of the day, like, the company having all the tools at its disposal to achieve that goal, including having equity up its sleeve to give to new supporters, to new investors, to new partners, to new value creating employees. Like, it just makes sense. Like, I would rather see that equity get put back into the pool, to have those who are still on the train, who still believe in the mission, who are still working hard at the goal, help us all win. It makes sense.
Yeah, 100%. 100%. Yeah, hey, look, we're nearly running out of time, unfortunately, but that was really, really cool. Love, coming from a family office perspective and investor portfolio perspective. I think we unpacked some elements of creating wealth from startups that we haven't yet done on the pod. So really grateful for that, Judy. Thanks heaps. And, we almost always finish with health and mental health, and, our creative, healthy lifestyle at Cake, we believe, is a huge part of why we're building a great company based on our great team. And, you actually have a bit of experience in this space. Yeah, it'd be great to hear your insights, on health and mental health as it helps innovators. Yeah.
Totally. Happy to talk about it. Before I get on my soapbox about mental health and well-being, one last quick thing I do want to share from the Euphemia portfolio that I thought was quite useful is how founders thought about advisor equity. And it's really common, I think, to have like advisors pitch for equity. And this theme that came through was that it very rarely was something that founders would look to do, because your business changes so quickly that it's quite rare. Like, by the time you're finished negotiating, an advisor equity agreement, that problem is no longer relevant. You've probably already solved it, or you've pivoted out of it, or like, so it's pretty rare to find an advisor that will be relevant to you for 7 years and actually earn that equity, even if it's being vested. And so it's a very expensive, in the long run, way to pay for advice, especially when there's a lot of free advice out there from peer-to-peer support programs, the startup network, other founders, investors. So there's a bit of a cautionary tale there on advisor equity coming out of the portfolio. So I just thought I'd share that. But on the founder health and well-being side, during my time at Startup Victoria, LaunchVic, the state government startup agency, commissioned us to write a report sort of detailing the state of affairs of, founder mental health and well-being in the Victorian startup economy. And I got to sit down and interview all sorts of founders from all sorts of walks of life and just like understand their journey. And one of the main things that has still stuck with me from that piece of research is how lonely it is to be a founder. It's a really hard job. You're so alone.
Don't set me off. Don't set me off, Judy.
Seriously though, like, you'll understand it. Like, even if you have co-founders, the type of problems that you're solving are massive, are complicated, are probably something you've never solved before, and have massive consequences. And it's a huge burden to be the person who has to find the answer, believe in the answer, communicate the answer, deal with the fallout. It's a huge burden. And often those kind of problems, like, they're confidential in nature. You can't talk to, your partner, your wife, your friends about them, and you've got no one to talk to.
Even still, from my experience, no one understands what you're doing. Like, they just sort of look at you like you're an alien when you say, like, you're a startup founder or whatever. And then every month, every 3 months, all the problems are brand new. Like, you're almost never solving the same problem twice. That's another big part of it.
Exactly. So, like, what I would like to see more in, like, I guess, like, the culture, of like this sector is like founder to founder stuff, because like, you can, like, I think that's a cohort that gets it right. So what, like, find your little group, whether it's on Zoom, whether it's down at the local pub, or whatever it might be, like, just find like 3 to 4 other founders at a similar growth stage to you, solving similar kind of problems, or maybe 1 or 2 stages ahead, that you can, in a confidential environment. Just like, they don't even actually have to help you solve the problem. You just need to listen And like, you just need to process. Like a lot of people like think by processing and talking. So it'd be great to see a bit more of that founder to founder stuff happen in Australia.
Yeah.
And then the second thing that really stuck with me on this topic is like how we approach failure in the startup sector. And I know this isn't a new topic. Lots of people talk about it, how we're not cool with failure, etc. But for founders in particular, there's so much of your personal identity wrapped up in your business. And so when your business fails, it feels like a personal failure. And so what I'd like to see more like, and I think there's also a bit of a narrative sometimes that comes from the venture landscape that like, this must be your everything, like, you're not investable unless this is your life's work, like, and I don't believe that. And I believe that there is a rising subculture to that sort of style of thinking about building startups, which is like this maniacal obsession, with like racing and winning. And I think it's healthy for founders to have parts of their identity that are outside of their business, whatever it is. So just to sort of take the edge off of that feeling of like, I have failed, like there are so many other parts of you beyond your startup identity, and nurturing those as best you can whilst you're on this crazy ride would be my wish for founders.
Amazing insights. I could talk about both those things at length, but I'll leave it at that. Really appreciative of your time. Let's get a buddy system in place, hey, for founders.
Yes.
Like with a buddy that's like a few years ahead. I reckon that'd be amazing.
Find a friend,
Find a friend. Look, yeah. So look, thank you so much for coming. Wonderful insights. One of the great leaders of the community and, friend of mine now, I think we can say. I hope we get to work together for a long time, doing our best to build the Australian ecosystem and the global ecosystem. Hey, let's go big. A lot of Aussie startups are going big, going global, so we should all be thinking that way, and we're a global community. So look, thanks for joining today. Really appreciate your time. Incredible insights. Absolutely love what you and Euphemia are doing, having a huge impact on the ecosystem and the planet. So thanks so much, and thanks everyone for listening.
Thank you, Jason. If people want to learn more about Euphemia, they can just go to euphemia.com, or they can look for us on socials. Most of our handles are Euphemia Invest.
Yes, good. Thanks for that. Good point. Forgot to do that.
Thanks, Jason.
All right, nice one. Thanks, everyone. Bye.